to have a Zoom meeting with me so they can really, because all of them are in the government. And so that was one of her things. And her mom just could not believe that no one had ever told her or explained it to her or broke it down to her in layman's terms what was going to happen to her life insurance that she felt the government had given her such a good package for. But as we all know, it's only while you're working. That lease agreement that you have on that life insurance actually, is not so good of a lease anymore. So I just wanted to share that I had to help a 76-year-old, and she, at this point, she realized there was nothing she could do but get a policy, a supplemental insurance policy, pretty much $20,000 to try to have something for her final expenses. So I just wanted to share that the information that we have and the knowledge is just so invaluable. I really wish we could get with these HR managers to really offer the alternative, because it is so much needed.
Oddly enough, I had that same conversation with someone today that's getting ready to retire from the federal government here in a few years and didn't really understand that vaguely.
So, Alma, I really want you to discuss something that hasn't really came up in, some other clubs that I should say some other rooms that I've been a part of in terms of the insurance, around how we're able to have debt elimination, right? So I really want you to talk about that. And so the other agents that are up here on the stage can know about this, because this is something that's really amazing. And we're seeing some great result with clients. And so if you can kind of, speak to that, that would be awesome.
Sure. So one of the big pushes that I have is the debt elimination using the leverage of a whole life cash value life insurance. For most of people that I run into, their thing is, well, I don't need life insurance for my debt. I only need it for when I die. And one of the things that I'm able to do is to actually show people how that even if you saved up money to pay off your bills, there's a missing component. The missing component is that your savings account will always net zero, because you have to save. Then once you save enough, then you pay off a bill. Then you have to repeat that cycle. So most people have heard of Dave Ramsey in some aspect, his debt snowballing program. Well, what we show people with life insurance, you all know that cash value life insurance, the dividends earn interest. And so what you're able to do is basically how I explain it is that you have a line of credit that you're building with help. The dividends that are in that account, they earn interest. And so now, instead of going to the bank to get a consolidation loan where you're paying interest and you're paying a fee for the people to consolidate your loan, I can show you how to use this cash value life insurance. A lot of times, I show people how to read out.
Hey, Alma.
So I'm not going to.
Alma, you're fading in and out. I'm not sure if you're in a good spot.
Can I just read out monies that they have to think? Yes.
Can you hear me?
I'm sorry. You said you can't hear me.
Yeah. You were kind of breaking up there.
I apologize.
Yeah, some good information. We definitely want to hear you.
I don't know why that's happening. I can hear you a little bit. That's okay. Give me a second. Let me actually move. I see Brandy on the line. She also works with me on the debt elimination. Move her. Can you hear me better now?
She says she couldn't move up. I tried to invite her to the stage.
Yeah, I'm not sure why my connection. I've not had a problem, but today it wants to have a problem. We know what we do for that. So move Brandy up so that she can speak on my behalf. on the debt program, because I don't believe in losing like this. So I don't know what's going on with my phone.
Yeah, right. Well, I'm inviting her, but I'm not sure if she's able to move up. That's the issue. Okay, good.
Good evening, everyone. How are you?
Welcome to the stage.
Well, thank you. I am honored to play tag team with one of my partners. We literally just got finished doing a national webinar on this idea of using life insurance to eliminate debt. And this is a critical aspect that most individuals are not aware of. And the key aspect that I tell individuals about is, or the first question I ask is, are you trying to work smarter or harder when it comes to your finances? And people, they come back and they're like, duh, Brandy, smarter. And I say, I ask that because what I'm about to share with you, you're really going to have to grasp the concept of the idea that you can use a dollar twice. There we go. Can you hear me?
Yes, perfectly.
Okay. Yes. And so when I tell people the idea of using a dollar twice, see, what Amma was alluding to is that our friend Dave, he will only tell us information to a certain extent. I am a little bit of a conspiracist. I believe that he will teach us how to have a certain level of wealth, but give us a financial cap. And we as minorities have to start having these kitchen table conversations about how to break that glass ceiling of wealth and creating dynastic wealth. And the way to be able to create dynastic wealth is through this idea of eliminating debts and using a dollar twice. So many people come to us and they say, I'd love to put more away for retirement, but I've got all this student loan debt, I've got this credit card debt, and all this stuff. People come to us and they say, I'd love to be able to utilize and have liquidity, but I'm bound by these debts. And we as America have been taught that debt is what we're supposed to have. Debt is what gives us the credit and things like that. And we hear all of that, but once again, they only give it to us to a certain extent. They don't give it to us all the way. We just get a little bit to think that we got enough knowledge, and that's the end point. But with this program that we have through life insurance, it allows us to do what Dave Ramsey wants to be done, but on a 2.0 scale. It allows you at the same time of eliminating, not consolidating, but eliminating debt, to use a dollar out in the world, taking care of these worldly expenses, this compound interest that we've never truly been taught about. And while that dollar is out in the world, it is still making money for you at the same time. It's like a matrix, but once you really figure out how it can work for you and leverage it, I truly believe that this is what will decrease the financial disparity between communities. Amma posted the other day that the average Black household's wealth is $17,000. And I've seen a lot of people post it because it was on Fox News. The average Caucasian household's wealth is $171,000. And the only way that we are going to level the playing field is by learning how to leverage that dollar, grow it, and use it twice, and teach this through generation to generation. I hope that answered your question, Shateka.
Absolutely did. Yes, you absolutely did, and thank you for joining us on the stage. Now you're here. Yeah, keep adding in, because she has so much value, and we have quite a bit of training going on. I partnered with them, I don't know, a couple of weeks ago, and I have been learning so much information. Brandy has her own brokerage, and so she's really helping a lot of insurance agents in the community to really level up in their field and to grow as an agent. And so I was pretty excited to join the team because they have really good training. And some of them on the stage, I've actually been in some of their rooms and I've been learning as well. So I'm probably one of the newer ones out, here. And so my goal is just to still, you ever seen somebody with zeal, but not a whole lot of knowledge? So that's me. I'm just trying to share the little that I know and bring everybody along with me, basically. And so the goal is just to empower our community so that everybody understands the power of life insurance and what it can do for them. Had I known what I know today, I would have started life insurance policies a lot longer, at the capacity, I should say, at the level or the criteria of insurance that I have now, basically. So most people don't know about that. So we just want to educate them on all the different aspects of it. Most people don't know that life insurance does have living benefits. I mean, you don't have to die to use it. You can actually, take it and really build wealth with it if you know what you're doing and really have a trust account and doing it the right way. But one of the things that most people look at it as is a debt, and it's not a debt. It's really an asset. So once we could, articulate that to them, and they can learn and understand the power of how they can leverage that insurance, more people will start doing it and start really, working their way into using insurance. Because what I've seen is a lot of people have been saying some other assets are actually working better than insurance. And I don't really see a whole lot of wins. I see people losing their money with some of the other investments that are out there. Some of them are scams. People are really trying hard. They want to do the right thing, but they're putting it in the wrong vehicles, unfortunately, because they're not skilled enough, or they're not able to really see the leverage that they're looking for. But this is probably the lowest risk vehicle of investing that I've ever seen. And I know that's probably a word you can't really use with insurance, but I look at it as an investment because of the return on investment that I've seen. I've seen so much returns come from insurance, more returns from insurance that I've seen in a lot of other vehicles that are out there right now. And maybe you guys can kind of speak to that a little bit more, because I really need people to understand the power of having insurance, basically. And so one of the things, for example, that we've seen out there is the 1 to 3 match, for people if they're looking to catch up on their retirement, account. There's different policies out there that they can put $1 in and get $3 out. And oh, by the way, they have a lifetime residual income forever until they die. And people don't hear that part. They only hear, oh, it's a death benefit. Oh, it's expensive. But what about the retirement income? What about the tax-free component about it? What about the fact that it has living benefits that, if you get chronically, critically, terminally ill, or chronically injured, that you can actually tap into that instead of your retirement account. And oh, by the way, you don't have to go bankrupt in retirement or have to go back and start working again in retirement because you started to have medical challenges. So I'm really passionate about really getting that piece of it out there. People don't really know, they just know that it's expensive. And that's what most people think, let's just, pay for term and invest the rest. But then who's really skilled at investing? Who really knows how to invest the rest, like an insurance company, right? If you're trying to take out the risk and you're really trying to see your money grow. So I'm going to get off my little soapbox and just kind of hear what you guys have to say, because you guys have have a lot to say, I'm sure. Y'all quiet.
I was waiting on Mr. Glenn to jump in there and talk about that whole life. But no, I completely agree with everything you said, Shateka. I just believe that when you know the true value of life insurance, you realize that the true value is not necessarily like within the policy in terms of the numbers. The true value is what it does for you outside of the policy and what it does for your family. And so when you're talking about debt elimination and things of that nature, a lot of folks say, well, how can I pay off my debt, or the cash value is only this? The beautiful part is that you're not understanding how much you're saving on interest over time. You're not understanding how much, debt and interest is creeping into your pockets and stealing away from you. So the faster we can get our debt paid off, and then if we can pay that off by ourselves without taking loans on that debt, then we're just putting ourselves in a better position for retirement. The crazy thing is, like, when we go into retirement, we still have mortgages, we still have credit card bills and things of that nature. And if you're able to go into retirement with your own bank, being your own lender, that just adds value and adds time to your retirement account, to your retirement portfolio, because you're not pulling out for things that you don't own. I hope that makes sense. But just knowing that, we can lower our interest payments faster because we're getting out of debt quicker. And then that we can secure more retirement income because we're not paying as much taxes on that income that's coming in to us, because it's tax-free, is coming from our life insurance. So I just wanted to reiterate everything that you said, but especially the point in that, the retirement income and then being able to get out of debt.
And Shateka, I think I heard, I'm sorry, I was kind of have my ear in two conversations.
it's just really not possible. But I think I heard you saying something to the effect that in protecting and growing some money in a whole life, as opposed to the risk of the market, when we're talking investment. If I heard you correctly, I mean, I thought that was ringing a tone with my heart, because I do appreciate the investment savviness of putting money in the market, but not over having some guaranteed fixed income or fixed asset growth like what the whole life does. Because in the end of the day, when the dust settles and the smoke clears, when you're investing in the market, we're investing in Elon Musk. Elon Musk never loses money in his process. We're investing in his company. And I think in the end of the day, as entrepreneurs, solo entrepreneurs, we have to learn to build our company as our investment that others can invest in. And that's the sweet spot at the end of the day, where major corporations in the market say, hey, invest in our corporation, we share our profit. But you're investing in their corporation, but their investment is their business. And I think that's a paradigm shift, that everybody's trying to be so market savviness, but we're not creating enough sustainable businesses that are transferable as a legacy in generational wealth, which is, hey, Walmart's here, Sam Walton, long died. I used to work for him, but their family still own that business that all these people work for and creating generational wealth. So I just think that's a dynamic that when you can use the whole life to leverage that your business to expand and grow your own business practice, it can be a healthy tool and a safe way to do it with no risk.
I love.
If I may, if I may, I think one of the things you can ask people, hey, do you want a bigger nest egg or do you want a bigger check in retirement? Right? And I think we've been bred to believe, hey, I need a huge nest egg. So you can ask somebody, hey, do you want a $5 million nest egg that you get paid $200,000 a year, but you haven't paid taxes on it yet? Or do you want a $3 million nest egg that pays you $180,000 a year, tax exempt, right? And I guarantee that make them go, let me think about that for a quick second. Can you say that again? Do you want that nest egg of $5 million that $200,000 going to be taxed? Right, so that means you get nowhere near $200,000. Or do you want a $3 million nest egg that you can get $180,000 tax exempt out of? And I think when we start putting things in that perspective to people, I think they'll really start to have a monumental mind shift on how they actually look at their assets.
Absolutely. Because when we think about the four pillars or the four cornerstones of wealth, one of them is tax advantage planning. And so key, because that's how we keep more money. And most people say, well, what's going on with my money? But it's really, how are you doing your taxes? And so when you think about retirement, and you think about what type of account you have, I've said this in a few rooms ago, anything that starts with a 4, it's really in the government's favor, right? 401k, 457, 403, all those, they're in the government's favor, because at the end of the day, they're going to be taxed later on, and they're going to be taxed pretty heavily. And most people don't understand that. And when we read the book, The Power of Zero by David McKnight, we know that that's going to happen, right? Social Security is going to go away. So we have to get in front of that and educate the community about that. And how can you get in front of that? By making sure that your retirement account is, you have a tax advantage plan when it comes to that. And I know I don't have a CPA in the room, but if you ask your CPA, they'll tell you the same thing. You really need to try to get into something like an insurance product or an annuity, anything that has an index attached to it, an index annuity or an index, anything that has an index says that there's a floor of 0, but it also has a tax advantage component to that. But of course, there's some other ways. There's some whole life policies that are there, that if you were able to see some type of income from that as long as you fund it properly, you won't have to have any type of tax situation, right? So the goal is to really sit down with someone that has the knowledge around making sure that that whenever you have a policy that is funded properly, so that there is no taxable event, But so that's really, really strong with what you're saying there, Marcus. And I want to hit on what Mr. Jones said. But before I do that, I do want to reset the room really quickly for the people that just came in not too long. We're actually talking about, 10 different ways that you could, 10 benefits of having a life insurance policy. There's so many ways, but we want to talk about that because most people only look at it as a death benefit. But if you leverage it right, you can absolutely build wealth. And I'm talking about generational wealth, and you can be the lender and not the borrower, And so the goal today is to really talk about that, strongly. And so you talked about Sam Walton, Mr. Jones, and so many other, greats out there like, Disney and so many other companies that's been actually birthed out of life insurance. They literally just took their life insurance policies and built these major corporations. And so we just need to be educated on that and see how we can, build our companies even more as well. So anybody want to speak to that?
Well, I'm still, you pushing buttons here, and you're a good button pusher. So what I appreciate in what you're saying here, and Mark was hitting on it too, we need a paradigm shift and how to really leverage and create perpetuitous wealth. And what has happened is that we've been massaged by the people, the Dave Ramsey, the Susan Ormans, and the people who are investment savvy. Please don't get me wrong. I am not trying to take away people's desire and thirst to invest in the market and make. I got money in the market. Don't get me wrong. And it's making me money. But when it drops and lose all the money, I'm not happy. Or lose some of the money, I'm not happy. And you ever heard of Murphy's Law, that when things can go wrong and they do go wrong, the government set up the 403B, the 457s, and the 401ks, so that what they said, they didn't want 30% of your money when you had $100 or $1,000. They wanted 30% of your money when you got $100,000 to $200,000, so they can buy those silver platinum bullets and those jet airplanes and $1 billion planes that they own, the companies that they, the bullet should only cost 10 cents, but they pay $100 per bullet and made themselves legally stealing rich off of the taxpayers' dollars. And they train us, and they got everyone training us to put our money in the market, and then markets are in things that there's no guarantee, or that they can take their tithes and offering. Their cut. And so when we wake up and read the 3 books or 4 books that say, oh, the wealthy 1% put theirs in the whole life policy to guarantee the transfer of wealth and create wealth tax-free, why is it so hard for us to digest? We done heard wrong so long that wrong become right and right become wrong, or it's not best practice. Let's put it that way. We're not going to call it wrong. We're just going to say it's not best practice, and it's not fared well for us as a people in terms of keeping and maintaining systemic wealth. Hello, Breaker.
So good. I love the passion. I love the passion, but can I break real quick and say, everybody in the room, please ping at least 10 people. Can we get at least 10 more people in this room so that we can really go deeper with this conversation, because people really need to hear this. So if you've learned anything, raise your hand. I can see, so I can know who is actually learning something so far. But before we go any deeper, if you can just ping 10 more people in the room, I would greatly appreciate that, because people need to hear this.
Yeah, I've been pinging since I got in here. I haven't stopped.
Mr. Glenn, I just want to follow up behind that, and I know you're going to love this because you're a spiritual guy, and I know you lead from the heart. And if I were to ask any farmer, anybody in the world, would they rather pay taxes on their seed, or would they pay taxes on the harvest? And everybody's going to say, smart people are going to say they'd rather pay taxes on the seed. And I think that's exactly what you're talking about. When the government allows you to build an account that has up to $500,000 and you never pay taxes on it, they want you to pay taxes on your harvest when it's time for you to go reap what you put up. But if you pay taxes on the seed, on the initial investment, you're going to get back tenfold. So I think, like everybody's saying, a paradigm mindset shift, because they have influenced us. They have taught us that tax deferred retirement is the best way to go, and it's really not. People look at it. Go ahead.
I just want to come in right where he and Glenn dropped that nugget about the 401k. My discipline is in engineering, and so that's where I come from. And I'm the left brain that goes and looks at things. And so I was curious, because I started studying the United States taxes from inception. Okay, and so I ran across the benefits consultant who in the late 70s, started in 1978, who actually came across what we know as the 401k section of the IRS tax code. His name is Ted Benner. And what happened, like all things in the government, is called loophole. So during the 80s, if you look at the tax brackets, the taxes were high. Reaganomics, okay? Taxes were high. The 401k was only a loophole found because they were trying to pay executive bonuses and shares of stock without them having to pay taxes because taxes were high. So the 401k was never meant to be a retirement plan. But what happened because of the loophole, the IRS found the benefit in keeping that and pushing that to the employers. So employers found out that they can get their left hand greased by the government while their right hand is appearing to give something to their employees. But it really is just a loophole. I tell people this: you need to understand when the 401k had a benefit to the employee when taxes were extremely high, because the whole principle is that you put your money in a tax deferred plan when taxes are high so that you can go when taxes go back down when you need your money. Now you are paying the government a lower rate on taxes. But because it did so well and the correlation with the stock market was just they were like, wait a minute, this is the new plan. So now employers were able to get huge tax write-offs because now they were matching funds to fund this for their employees. So I tell people, go and history will never tell you the whole truth, but it won't tell you we know history and we know who writes it. But the guy who found the tax loop, he actually regrets that he actually found that because of how it has been used and the disadvantages that it has been putting workers in. I just wanted to drop that little piece there.
Oh man, you just hit something now. I tell people this all the time, and I'm like, if you and then if you look at it, what happened when they created the 401? Pensions went away. Companies no longer had to pay somebody for the rest of their life, and no longer were their bottom lines getting shorter, because now they've now twisted it away to now they put it on the individual. Oh, we can kick in a little something here and here, because that's some change compared to what we would have been doing by paying them for the rest of their life. At the time, it sounded like a great idea, but again, that happened in 1970, over 40 something years ago now. It can't be the same thing that we're still using. But majority of the time, we're looking at the right now. Hey, I need to figure, especially my high income earners, I need to figure out a way to lower my taxes right now. I'm getting beat over the head, so this is what I want to do. And what I tell people is that's all fun and dandy. We can do that, but at the same time, we need to figure out how we build some tax-free money as well to offset that. And my biggest thing, I was like, I love Ross. I'm all about Ross. But I say, have you ever thought why they limit the amount of money you can put into a Ross? Think about that. Think about that. They limit literally how much money you can put in a Roth. 6,000 or 6,500 versus 19,500. That's a huge gap. That's a huge gap. They're like, hold on. Like you say, you can put, matter of fact, Max out, put 19,500 in there every year for the next 20 years. Doggy, man, we about to tax you for $3 million, right? Versus that little $6,000, $6,500 if you're doing catch up. That's huge, man. Think about that.
Just to follow behind you.
Right there.
No, go ahead. I always like ladies to go first, please.
No, you're good. I'm just saying he just got me that he dropped it right there because he Marcus and I talk the same language. I mean, that is true. That's all I wanted to say. He just dropped it right there.
I always talk about taxes right now because when the tax code was first written, And if you think about taxes over time, we're still below the median average of where the tax rate once was in our country. Oh, yeah. So what that tells me is that taxes are only going to go one direction. And so it goes back to what I was saying earlier, is that you want to pay taxes on the seed. You want to make sure that you're given what you owe right away. If you're paying taxes on the harvest, if you're having a tax deferred account, that's like going in debt because you have money that's not really yours yet, right? And that you can't account for. So what you're saying, Marcus, and what we're talking about in this area, I think is something that's so important in our industry, but even for our community, is that people need to understand the ability to pay taxes up front, and then to know that whatever you put inside that life insurance account, when it builds cash value, there's nothing that can keep you away from that. I used to work for National Life Group, and it just feels like that people think the cash value intact in their life insurance has some type of stipulations to it, and it honestly doesn't. I was speaking to a representative at National Life Group a couple months ago at our national conference, and what he was saying was, listen, man, if you have cash available, that is yours. That is your cash. There's nothing we can do to keep people from coming in and out of their policy. So it's I am building a savings account that's growing at an unprecedented rate when I compare it to the savings accounts that the banks offer. And I'll be able to receive it tax-free. I don't have to pay them, but if I need to access early. So I just want to really, really harp on paying taxes up front and not paying them on the back end.
I'm 100% agreeing. So everybody, ask anybody what's the highest tax bracket that they know of, and they will think now. I'm like, no, we actually the lowest. You realize the taxes was once in the 90 percentile, man.
Exactly. And so at the end of the day, when the dust settles and the smoke clears, it comes back to, listen, the government's going to get their cut. They're getting it right out your check. As Flip has said, paying it on the seed on the money that's come out. And the advantage, I think, over the Roth in this process is that the Roth will never have a death benefit greater than what the whole life will. So you got some gains and growth in the whole life, maybe not as fast as the Roth, but you put in $50,000 in the Roth, and now the Roth is up to $100,000. You put in $50,000 at the whole life, and maybe it's up to $65,000, but the whole life has a death benefit of $300,000 or $400,000, which is best for you, and it's all tax for free. When the Roth is whatever you got, that's what you're gonna get. So I think on the end of the day, and this is why I'm an advocate for the insured, and I'm an advocate for the agents too, to know this here. We have a job to do to change the paradigm and make people understand, do not drink this Kool-Aid of just buy term and invest the rest. It is the most damaging things to our community, because typically whenever there's someone laid to rest, because I don't know if it was a good, bad cop situation, but the camera seemed to reflect that the only people getting taken out in these bad cop situations seem to be us. You don't find the Asian, you don't find the Mexican, the Puerto Ricans. It just seemed to be us people. And I think the one holistic solution is a whole life policy over 6 figures. Over 6 figures. Money talks, the rest walks, and money answers all things according to the word of God. And if $500,000 or $1 million was on everybody, or we would have this problem, brutality resolved. But here it is. I finished with this statement. The average Black American, and even in this room, most of the time in these insurance rooms, in these rooms, in conversation, it's pretty much females that really give a hot care. Okay, the brothers typically, if you run a survey, hey, run that survey, Shateka. If you're a brother in the room, raise your hand if you got on you more than 10,000 in coverage on you. It's gonna get silent. It's gonna get silent because we don't care. We get it on the job, we lose that, and don't have anything and no way to guarantee to transfer wealth, no asset protection. And so they just simply say, listen, there's no value attached to your life, and if we take you out, you'll run through the streets, and we'll lock you up and tear up buildings, and still your family be broke, busted, and disgusted.
I gotta hop in here, y'all. I gotta hop in here because Glenn just got me up out my seat. I'm gonna share with you guys the reason why I got into life insurance. 7 I only started this 7 years ago. I met my husband when I was 15 years old. We got married at 20. He joined the United States Marine Corps. That is a place where people assume that because you fight for this country, you will have the benefits, the retirement, the real pleasures of this world. My husband went through 6 deployments in 6.5 years. We had 2 children 13 months apart. When they were done with him, he had severe PTSD. They told him he was washed up, no good, gotta go. And they medically retired him and kicked us out in 30 days with an honorable discharge. But because they were so quick to get rid of him, because they didn't want to deal with what they had caused, I, like many Americans, assumed that his lovely job was going to give us the benefits that my family needed. I assumed, like many Americans, because we were young, under the age of 30, that we had a lifetime ahead of us. We got out of the military. We started a business. We moved back to the East Coast. And within 8 months, my husband was killed in a car accident, a hit and run accident. You guys, because he was a black male, it didn't matter how many stripes he had on his chest. The police department could give 2 craps. They never looked for who did it. It is an open case. And all I kept hearing from people in my circle was that the military will take care of you. He had benefits. Within 72 hours, my heart dropped again, because when I went and called the Marine Corps, even though they buried him honorably, even though he had a 21 gun salute, you know what they turned around and told me? There was no life insurance. They had not filled out the paperwork. Myself, and at the time 3 children, 5, 4, and 4 months old, had to pull ourselves up by our bootstraps and make something for ourselves, because we were left nothing, because we did not know that we were leasing those benefits and nothing was owned. So you know what I did? I went and got a license, and I said, I will never let this happen to another individual ever again if I can completely help it. And that is why all of us are on this line today.
Brandy, I'm a 20-year veteran of the Marine Corps. I retired out of the Marine Corps, so I understand everything you were talking about. I understand the deployments, I got you. I understand it all, and you are definitely right. And this is one reason I reached back out to my military folks, because they don't talk about this stuff. They don't teach you about it. And we think, hey, while you're there, you'd be like, oh, I got a $400,000 policy. We're good. And we're never really thinking about breaking down the numbers and stuff like that. When you exit it, they don't. You get this little BS hour, 2-hour brief from the VA that tells you this. But if they don't tell you, if you don't do X, Y, Z by this time frame, all of this is null and void, right? And so, yes, dang man, you oof.
So I'm just screaming. Go ahead, Rob.
Hey, good evening, guys. So sorry, I'm sitting back, and I'm proud to be in the room with the advanced level knowledge of insurance agents that are in here. I actually sat down with a client last night who is soon to retire from the military, and he mentioned some benefits, some SGLIs and some things like that he may be privy to now or when he gets ready to retire. So some of this stuff is new to me, as far as what kind of benefits they may or may not have access to. In my short little bit of research, I understand that those policies, I believe, are term policies post-retirement. So I would love, I don't want to take over the conversation, but I would love to talk to anybody who can bring me up to speed on how I can help this client understand where his best moves are. Obviously, I'm going to talk to him about whole life all day long, but I do want to, just get some more information on what kind of, nuggets I can use to help close it.
Wow. I'm a veteran as well, and that's one of my areas, dealing with military veterans or soon to be veterans, or people just exiting the military. That's one of my passions, because the education that they get definitely is one of the things. Is you got to remember, people go into the military very young, and their human life value, they're literally allowing it to basically be wasted away because of lack of knowledge. They're at the height of their most monetizable value for themselves. And so the biggest thing that I've been able to do, I have several military clients, but the thing about them when they get out, and it's a shame that this has to happen, they have to go to sick call and all of these things to claim ailments that they should not have to do, because that really tears them up when they get out. So now the products that we have for them to take advantage of, they're in a position not to be able to take advantage of them as much as they need to, because they have 20,000 medications in their medical record. They have migraines and things like that. Unfortunately, here's the catch-22. A lot of our people, they don't have this reported, but because you spent 20 years in boots with rucks, you deserve to get benefits and pay. So a lot of times they're put in a very, very bad situation. And my thing now is trying to capture them before they start trying to exit and get their VA benefits, because that's where a lot of the gray area is. And one of the things I will tell you is to start asking that soon to be retired veteran, what type of additional benefits are they looking to secure for themselves, and have the understanding that you understand why. There's no judgment, but we really trying to help them maximize the little bit of themselves they have left, if that makes sense. And I'll let the other gentleman who wanted to jump in, but that's something that I have a passion and a little bit of a niche for.
Hey, Ruff, I sent you a DM, man. Anytime you want to talk about it, I'll be happy to give you the whole spill. Like I said, I'm retired in Marine, did 20 years, but the infantry the whole time. I got plenty of ailments, right? That's a lot of this stuff, and she's absolutely right. You know, as I started to get ready to transition, I started going to medical, getting out, all this stuff put in and everything of that nature. And never really thought about the insurance piece until towards the end, really. And really realizing, hey, man, there's nothing. So yeah, man, I won't get on soapbox at any time, and I definitely love talking to you, brother.
I want to mention something, Montana, you just said in the dynamic of the process, that there's a window of when people go in when they're in their best shape, they're in their best health, and over the period of time, when they get ready to come out, they're not in their best shape and not in their best health. Now, typically, I feel that everyone that ever went in before they went in, they should have had the proper type of coverage going in, because, we need to be proactive in this stuff to say, listen, and start talking to families. If your children are likely to go in the military, you need to get this type of coverage right now. Let it cook and bake and make money, because if they do go in there, they can't get it while they're going in there. Hello. And they offer that long as they're in there a plan. But when they come out, now their health is changed and deranged, which is why I'm screaming, we have got to erase this program thinking that whole life is too much, because we missed the window in the process of a cycle of getting coverage when we're young and it costs less. And then on the back end, we say we really can't afford it, then it's out of the question. So had we had the right perspective and the right relationship in advance, and that was the time to get it, every time we're born, we should have got this coverage on this. And that's what the wealthiest 1% have done. The Rockefellers got their wealth, maintained their wealth, and sustained their wealth through the generations through life insurance. Hello, breaker, come on.
You always lean.
Yes, he is. Yes, he is. And I, $50 a month for a 7-year-old male, $100,000 of whole life, paid up in 20 years. He'll never have to pay for it after it's paid up in 20 years. And that's just $50 a month. And that's in excess, right? That's actually more than what he should pay. That's more than the contract premium, if you know what I'm talking about. So he's building cash value at an accelerated rate, and he has $100,000 of coverage for the rest of his life. His mother will only have to pay for it for 20 years. Sister, she's 2 years old, $50 a month, same situation, $115,000 of coverage, whole life, paid up in 20 years. So it's not expensive if you do it right and if you do it early. And I'm on that same train that Mr. Glenn is on. The earlier we do this, the better it can be for us long term. $50 a month and $50 a month in your kid's future is nothing. And then when you start talking about the benefits that they have in terms of the living benefits and the cash value accumulation, what they can do with it when college, what to start a business with that cash value in 10 to 15 years, there's just so many things that they can do by becoming their own bank. But I'm saying what he's talking about, 6 figures of coverage, whole life guaranteed for 20 years for under $100. And if we do it early and if we do it on our young ones, then, I mean, we don't have anything else to worry about.
Absolutely, brother. That's been a hot topic for me. It's been a huge run up with clientele with those approaches 10 and 20 year paid life insurance policies. Man, just hitting up my existing clients and also posting and sharing about it. Man, that's a big draw. So if you're aging, you're not focused on that, or you haven't tried it, you're missing out on a great deal, because there are people whose ears will perk up if you approach it right and sell it to them the right way and show it to them the right way, educate them the right way. I don't like to sell anything, but like educate them on what those benefits are, just like you laid out. You know, and you're talking about the Rockefellers and other generations of white wealth. It's all about, you know, making sure that transformation takes place with life insurance policies, making sure that those businesses that have been established and that property that's been purchased can continue to be maintained with the cash that's going to be guaranteed to come through. It's so much, man. That's again why, you know, I said this last night on the other platform that Jalinda and Mr. Jones was holding was, you know, I love the fact that we can talk about so much and not even talk about anybody dying and get into how powerful this stuff is.
And you know what? Also, in Shateka, for the agent, as an advocate with the agent, really, if you don't do the whole life, as an agent, if you're only selling term, you're doing yourself a disservice, because term only pays commission on the first year. We want residual, baby. We want it to keep coming and coming, and we need to start. If you had any happy good sense, as a, you know, ignorance goes to seed, we need to come to this reality that we should have been selling whole life. The day we sold our first policy, we should have only been selling whole life, because it gives trails. It's trails on it. And so our job gets easier the more whole life we sell. We're protecting families and creating their banking situation, but we also are creating residual revenue, so residual income, so that next year you don't have to start from scratch one trying to generate money to pay your bills. You start having a revenue trail that comes every month, whether you work or not. Hello, breaker.
But you know, and I get it. We have some empathy for people, and you know, after you educating people, they're not always, you know, wanting to go, you know, outside of that term, because that's a mindset shift that has to happen, a paradigm shift that has to happen, and they have to really see it. And I'm not talking about selling it to them, but really articulating all of the benefits. And so just to reset the room tonight, we're talking about all the many benefits that people are not aware of when it comes to life insurance. And we're not talking about term, we're talking about the whole life, and not because, you know, of any self-gain, but because of all that it can do for our clients and all that it has done for so many people, especially corporations, as we have already mentioned. But if you're going to have a term because of your budget, because it doesn't, I mean, it fits some people's budget, then we just ask that you do 2 things. Check and see if there's a return on premium involved, right? So that you can get some of that money back. Or if it's convertible, if you can upgrade, right, to a better policy later on when you can afford it. So those 2 things is what we ask, you know, people to do if they do have to, you know, get into a term product. Now, I know Euro and Eris have been on the stage for a little while. I did want to give them some space to ask any questions that they may have, or anybody else in the room that may have a question. Please come on up on the stage. We're inviting you up. This is your time before we close it out.
Hey, real quick, I just wanted to say I'm going to step out. Just thank you guys for having me up. I've learned a lot. I've been taking notes while I was cooking, so I'm going to step away. I've been working all day. I got to go do some TV time with my queen. So you guys be well. Thank you so much.
I don't know, Rob.
Thanks for joining.
We finna tell some more stuff that you might want to hear. You getting off just a minute too soon. We finna drop another nugget, bro.
I'm gonna see if I can pull out about 5 more minutes.
Everybody paying 5 more people in the room. People need this. They don't know about this. Please paying 5 more people in the room. And then Euro and Eris, you guys have any questions? Anybody else in the room have any questions?
I do. I just want to say I came into the room late for one, but I'm so happy that I came. I'm new to Clubhouse, but I'm also new to the life insurance world. I have a nursing background that I recently, decided to make the switch, and I'm happy that I did. Because I'm still able to help people just in a different way. And what I've been hearing so far, you guys don't even understand, like you just helped a light bulb come on, seriously. So I just want to say thank you for all the gems that you are dropping. And, my husband was in the Marine Corps for 8 years, so I definitely have that military background as well. I believe it was Brandy who was saying that her husband was in the military. So my deepest condolences to you as well, because I did hear your story. But it just has so many creative juices flowing in my mind as to, I live in California, and where I live close to a base, and it just has my creative juices flowing. So I'm just saying thank you, and I appreciate everything that you guys are sharing. I have my notebook, my pen here, ready, taking notes. So I just want to say thank you.
Shout out to California, Camp Pendleton, Camp Miramar.
Camp Pendleton, yep. Whoop, whoop.
That's funny. Thanks for joining us on the stage, Erison. Thank you for your comments. Euro. Perhaps Euro may not have a question. Anybody else have a comment?
I do.
Go ahead, Mr.
Go ahead, Flip. I yield to you, sir.
No, I was just gonna say, because I talked about those children policies earlier. I always want to make sure that I mention this. Make sure that every time we do something on the juveniles, people under the age of about 25 to 27, that we're adding the guaranteed insurability rider. And so that's for agents who don't understand, who never heard of that, but also for the people in the audience, to make sure that you're adding your guarantee insurability rider, because what you're allowing yourself to do and you're allowing the insurer to do is to add coverage without going through underwriting. And so the earlier we can put a GIO onto our children's policies as they get older, no matter what their health condition is, they're able to add to their coverage without going through underwriting. And we know how strenuous that can be, right? So just want to make sure that I kind of throw that out there too, is that the guaranteed insurability is so important just because it allows you to add coverage.
Hello, guys. Can you hear me?
Yes.
Loud and clear.
All right. Sounds good. My boss. What's going on, Mr. Jones? I'm all ears, you guys. What's going on, Flip, Marcus? Everybody, Shateka, man. You guys are the OGs with this. I'm the baby, in this field. I would like to tell you guys a quick story about myself. I got started out in music business back in 2013. I met a Wall Street wealth manager, and then I had an opportunity to work for run a Fendi location down in Atlanta, Georgia, because I'm originally from New York. I had built a corporate structure, right? Very, very intricate corporate structure. I built that myself. I went to the E-Trade brokerage, and I gave the guy my papers, and I said, sir, I want to build a corporate investment account. And he gave me the double take because I looked so young, and then he seen my paperwork, how it was built, and he said, this is very, this is specialized knowledge. And he said, are you in finance? I said, no. And he said, you want to be in finance? I said, yeah, I would love to, but I know the restrictions. And then he said, well, FINRA just administered this new test called the SIE. So all you got to do is be 18 years or older and pay to take the test. And I said, okay, cool. So I bought 2 books, no course. I didn't take no college. And I self-educated myself, and I passed that test. And I came back and I gave him, I showed him my passing score. And then fast forward, I got hired for a financial institution out in California just October of this year. Now, look, I did 1 semester in college. I dropped out of college. I built my own music company. I've been featured on major magazines, television, co-signed by music legends, all of that. Now, for me to be a young African-American man and to self-educate and to be able to even get sponsored, you guys know how hard that is. And so my background came from studying securities and investments, right? And so the process for my job, the sequence is you have to take your life and health exam first.
and then you take the SIE, and then you take the Series 7, and then you take the Series 66. So when I started studying for securities, I started studying for the Series 7 test, because as you guys know, the SIE is just a smaller component of the Series 7. So I kind of was telling my onboarding director, like, hey, why do I have to take this life insurance, before that Series 7? And she said, well, Mr. Goings, you're actually ahead of the game because you already have your SIE, but it's mandatory that you take the life and health insurance. So I said, all right, I'll get it done. And it blew my mind when I started studying insurance, because I said, wow, I understand now why they make you take the life insurance before this securities test, because this is actually the foundation. And through my studies, I started to develop my own blueprint where, like, I'm writing a book called The Algorithm to Wealth, right? And so if you guys could just visualize a tree, it starts at the roots, right? And then the tree goes up, you got the base of the tree, then you got the branches. And all this is coming to me, and I'm like, okay, well, the root of the tree is the life insurance. And, you have the term life insurance, but then you have the permanent life insurance policies where you have that guaranteed death benefit tax-free, but then you also build that cash value. And then there's all these different kind of riders that you can add on to those life insurance policies, which make them unique for each individual. So I said, wow, before we get into any type of investments or any type of businesses built, we have to have that life insurance. That is mandatory. And it's like the most simple investment you could ever make, and the most lucrative one, because it has the best components of all these different types of investment vehicles, and it's guaranteed, and it's very simple to understand. And when I watched this video a long time ago, a couple years ago, and I seen how, and you guys can elaborate on this for me, because I'm like, it said how these life insurance companies have been around for centuries, and they was investing in life insurance, and U.S. Trust, U.S. Bank, and how these big institutions just started to combine with each other, but their foundation was life insurance. These guys had billions of dollars and combined from businesses, and then they just kept changing the names of their businesses. But now it's U.S. Trust and Bank Merrill Lynch, and all of these things I seen, they started out, the foundation was life insurance. And like, all of this blew my mind. So now I just want to say I respect all of you guys here, because you guys are doing this. I'm the baby. I'm taking my life insurance, my life, health, and accident insurance exam on March 12th. So I'm deep in my studies. So if I'm on stage and I'm quiet, it's because I'm listening and I'm learning. And I just wanted to say thank you guys so much. And because you guys are really explaining it and making it much clearer. So, I mean, this is just invaluable knowledge. And I mean, like, that is really where the foundation starts for the wealth, where it starts with that life insurance policy. And I mean, this is great.
Listen here, baby, we appreciate you. We appreciate that, the root of the tree, man. That's awesome. That's like a part of my logo too. I got a tree, a little money tree. So I appreciate you talking about that root. You know what I'm saying? So thank you for always coming on stage and bringing value and just sharing with us. Your passion is, is ignitable. So we just appreciate that. We brought some more people up on the stage. Definitely want to hear from you all. If you're just joining the room, just going to reset really quickly. We're just talking about some great benefits that life insurance is able to bring, our clients, and just the results that it's bringing in terms of building generational wealth. So when we think about generational wealth, we really need to have that in our product mix. And so most people say, I want to, have, financial independence or financial freedom. You hear that as a buzzword now, but there's actually 6, steps to that. And of all the 6 steps to financial independence, and I'll name them really quickly, and then I'm gonna just, give it over to whomever's next. The 6 steps to financial independence. The number 1 step is going to be cash flow. You have to earn additional income. You have to manage your expenses. Number 1. Number 2, you have to have an emergency fund. You have to save 3 to 6 months of income. You have to prepare for unexpected expenses. Now, number 1 and number 2, you can do that with insurance. Number 3, debt management. You have to consolidate your debt. You have to strive to eliminate your debt. What else can you do that with? Insurance. Number 4, proper protection. Protect against loss of income. Protect your family's assets. How do you do that? Insurance. So number 5 is build wealth, right? Outpace inflation and reduce taxes. Professional money management. How can you do that? Insurance. The 6th way of the 6 steps to financial independence is preserve wealth, reduce your taxation, and build a family legacy, just like the Rockefellers. All right. All 6 ways you can do that with what? Somebody say it. Somebody say it.
Life insurance. And guys, I got my whole life insurance policy too. So while I'm studying and I'm onboarding for my company, like I got my life insurance, my whole life insurance policy with the paid up additions with the accelerated death benefit. So I'm actually putting it to use. I'm doing it while I'm learning it. You know what I mean? So I'm following you guys' lead. So you lead by example, and I'm already in it. So I want to say thank you so much, and I'm listening and learning, guys.
Shateka, I need you to send me that breakdown of how you spit that out.
Same.
So awesome, man. That's sexy on steroids.
Absolutely, a whole PowerPoint.
And I want to drop some on you all before Mr. Ruff has to go, because that guy's awesome on steroids. I love this guy. He's just really sharp. But I want to give you all this here. Part of the paradigm shift in what we do. Often I hear the conversation, and I think Shateka and Flip, you said it the other night, term with return of premium or term convertible. Those are, if you're going to have term, you should have that. But I want to begin to help the agents do a paradigm shift, that thinking when people tell you they can't afford whole life, that is as backwards as 80 going north, or, if there's such a thing. No, people can't afford. You can afford what you want and what you like. We have people, when we run the test, what are you spending on eating out a month? $200. What are you spending on hair, nails, pedicure? $200 to $300. What are you spending on cell phones? Another $200, $300. What are you spending on cable TV, Wi-Fi, internet? Another $300. So they're spending $800 to $1,000 a month on junk in the trunk with no return on investment. They're buying iPhones for children at age 4. You tell me they can't put it in whole life? So here's what it is. First, you got to get your head straight. I'm sorry, I preach a little hard sometimes, but I can't hold the truth. You got to rethink your thinking. That is not logical that they can't afford it. Affording is term, but whole life is saving and investing. So here's my example. You asked earlier, Shateka, about a story or what was your successes today. I just got off just a short minute ago with the client, and she owns her own business. Now, we discussed that rather than setting up 401k, SERPs, and all those other things, we're going to put it in the whole life. So she's looking for an annual premium around $10,000. Her husband's looking around $12,000. And then she wants to do the 20-pay whole life on the children at $400 each. Well, I had to walk her through a financial needs analysis and plan of how much wealth, and help them understand that now she'll be owning 6 banks, but $400 a month on each child and monthly premium. So what's that? $4,800 on each of those, and that's all in whole life. Did I mention that's all in whole life? Hello, breaker. What does that look like in the year? So the first thing is, we have to be on the page that we're putting them in a healthy position. Now, she was a white ninja, not a black ninja. And she got it. She saw the math and look at all the variables of what she stood to lose money and give the government their tithes and offering of 30% and a penalty of 10% if they pulled it out before age 59 and a half, plus the 2% that Susan Orman and what's his name, Dave Ramsey love so much, because they want their 2% fees, whether they make money or not. Whether they make money or not, they get their 2%. I just don't like the fact that my clients, they're like my family, that they're going to be suffering a loss, and I'm still getting 2%. I don't feel so good. I want your success is my success at all times. So I want to give them something where there's no loss. I can sleep at night, and they can have assets, and they need to start saving for the bank, because the bottom line, when you buy a vehicle to the bank, they make the money at 10 or 12%, and you giving them the money, end up broke, and the car ain't worth jack in 10 years. When you could have bought it yourself and financed it, and now you put the money back in your pocket, and you stand earning 10%. Hello, breaker. So I just want to push this home. We got to get everybody on the page. We need to insure our families with whole life, and we have to change their thinking by changing ours first. That you got the money. Stop putting it in the junk in the trunk and put it in your family. Invest in you first.
Hello, breaker. The preacher has spoken. Drop the mic. Cassidy, take over.
I'm sorry, I'm trying to come off mute without having too much background noise from my children. Hey, y'all, I'm so sorry I'm late. I'm blessed to just be in the building, student of the conversation, supporting what y'all doing. Thank y'all for the accountability that you place on yourselves with this collaboration, teaching our people how to get secure the bag. I'm just happy to be here. I don't have any agenda or anything. Definitely not trying to take over your mind. I just appreciate what y'all doing and I'm learning.
Awesome. Gary, I see you on the stage, and Kimlia, either one of you. And yeah, that's it for now, I think. And Antoine and Tony, do I have anything?
Okay, I'll go. Thank you, guys. Thank you for having the space. I just wanted to add to the insurance conversation. I know Shateka gave us the 6 steps for securing our transfer and generational wealth, but I wanted to add, well, having the insurance is great, but we need to make sure that we're securing the insurance benefits. And as an estate planning attorney, one of the challenges that I see within the community is that we will name beneficiaries, and that money gets transferred to the beneficiary and it gets misused. It gets, so I encourage my clients that if you're going to, well, obviously have insurance benefits, but you also want to make sure that you're securing them by creating an irrevocable life insurance trust so that you get to decide who gets those benefits under what terms and when, and that way you are securing it because it's in a trust, and you don't run the risk of the beneficiaries losing the money for say divorce or debt liabilities or so let's say that they got into, they're sued or something like that. If they're sued or if they, child support, any type of debt that they owe, they could potentially lose those insurance benefits. But if it's in an irrevocable life insurance trust, then technically the beneficiary doesn't own those assets. The trust own the assets. And that way, even if they have those liabilities, then they don't stand the risk of losing it. So you use it as an asset protection tool.
Thank you so much for coming in the room, Kimlia. We love your type of attorney. When you come into the room and you bring that value, we need that because that's like literally closing the whole picture, right? Like we have to have that part, that piece, in order to make sure everything, works for our generational wealth. So thank you for what you're adding to the conversation. And we invite you to come back, right? Every Thursday night at 8:30 Eastern, Standard Time, we're here. So please bring that value whenever you're available on Thursday nights at 8:30. So I heard Mr. Glenn talking about, okay, go ahead.
Yeah, Camila, is Kimla or Camila?
It's Kimlia.
Kimlia. That's a beautiful name. I like it. Listen, in your opinion, do you feel that the irrevocable trust should be utilized? Because if it's irrevocable and say they got the policy in there and they have someone as a beneficiary that dies before them, couldn't that be a problem because it's irrevocable and they can't access the policy to make that change?
No. The reason is because the trust becomes the beneficiary of the policy, not the named person. So let's say that I had a policy and you were the beneficiary. Once I transfer that insurance policy into an irrevocable life insurance policy, the trust becomes the beneficiary. And within the terms of the trust, you get to decide who gets it and when. So under normal circumstances, if you had a named beneficiary, they would get, all of the assets at once, right? But if you put I want John to get it, $25,000 when he goes off to college, and I want $15,000 to be paid every semester. You get to define how those assets are being utilized versus, in a traditional policy, you just name the person as the beneficiary. Let's say you have a 19, 20-year-old and they get a $500,000 insurance policy. How well do you think they're going to manage that? Probably not in the way that you expected. However, if you name the trust as the beneficiary, you get to decide when they get it or even if they get it.
But if the trust is named the beneficiary, and I'm just asking, the irrevocable makes there can't be any changes, period. That means whatever you spoke, it can't be changed.
Well, let me say, the irrevocable life insurance trust is solely for the life insurance policy. not for anything else. You may have a revocable trust, you may have an irrevocable trust, special needs trust. There's so many different types of trust. But when you're creating what's called an island, it's solely for the purpose of that insurance policy.
Right. And the problem I have is that this lady, I was doing a radio broadcast, right? And she owned these policies on her children and her grandchildren, because that's how we did it in years back, right? The guy sold the policy on the parents, the children, and the grandchildren. Yeah, you got that little child. Go, let's put a policy on. Now, the problem was she's the owner and the beneficiary of those policies. And so once my thinking is when she puts it in the irrevocable and she's the beneficiary, you put it in the trust, but in the policy, on the policy itself, she's still the beneficiary, but she's transitioned. That's why I'm saying there's the problem. And I told her, let me finish this here, and I'm going to hear you. But the problem was that we needed to make her change some of those situations because she's on her children and grandchildren policy as a beneficiary, and we were going to change it on. I told her on a Friday, and we were going to get together on a Sunday. Well, and make those, or Monday, and make a change. But Sunday she died, and now she's still the owner and the beneficiaries on the policy, and that's a whole nightmare.
Okay, so in order for you, when you create the irrevocable life insurance trust, you change the beneficiary on the policy. That's how you convert it to an irrevocable life insurance trust. You create the trust, and then you change the beneficiary in your situation from the grandma, the aunt, or whomever, and the trust becomes the beneficiary, not an individual.
I understand. So even when we have policies, we do people where the adults do not have anybody over 18, their children, to leave it to. And they may have one primary, but they have contingent, and they say their children are under 18, so we can't even make them the beneficiary. We tell them we have to set up a trust for the children. But in that case, we've been doing it where they set up the trust for the children as the contingent, not as the primary.
And you're creating an irrevocable life insurance trust?
For the contingency beneficiary, which with the children since they're under 18. So they wouldn't know how to manage the money, and they can't receive the money, can't be paid to someone under 18. So you put the irrevocable under the contingent beneficiary so that it can be constructed to make sure it manages how they receive those funds and when they can receive them.
Okay, so in an irrevocable life insurance trust, the children don't necessarily, the beneficiaries don't necessarily, well, the beneficiaries aren't the named individuals. The trust will be
the contingent. You're making the trust the contingent beneficiary.
Not in an irrevocable life insurance trust. In an irrevocable life insurance trust, you're creating the trust solely for the purpose of that insurance policy. You make the trust the beneficiary of the insurance policy, irregardless of whether or not the kids are of age or not, because in a trust, you get to decide when they get access to those funds anyway.
So I think you're saying when you any person as the beneficiary,
But I don't know if you're breaking up or there's not signal.
No, he's breaking up.
Okay.
Yeah, he's breaking up. But Kimberly, you just dropped the whole bar. You said the trust becomes the beneficiary. Now, if you actually have a house, I know this isn't insurance, but just wanting to know this. Someone passes away and they have a home. You put that in a trust. You're saying that it needs to be in an irrevocable trust so that the probate or the state doesn't take that home away?
Oh, no, I didn't say that. I didn't say that with regards to the home. You can put a home in a revocable trust, and a revocable trust allows you to amend, put stuff in, take stuff out. When I speak about trust, the easiest way, the most basic way to understand it is an open box and a closed box, right? You create the trust as an open box, the revocable trust, right? Just think about it. If you can put stuff in and take stuff out, it's revocable, right? So if you can put stuff in and take stuff out, then the creditors can take stuff out as well, right? But typically in a revocable trust, when the creator of the trust, when the grantor of the trust transitions, then the revocable trust becomes an irrevocable trust, meaning that you can't make modifications to the trust.
That's understandable. Very good.
And Camelia, you're in a specific state because, and can you speak to this too? And I like what you're saying. That's another motivator that every insurance agent needs an elite relationship. What I call a Justice League person such as Camelia to help us with that part of estate planning once those plans are put into place, nonetheless. But in the state of Florida, uniquely so, that one of the things was in the state of Florida that life insurance and lawsuits isn't accessible in Florida, and so that's what sustained OJ. When he had life insurance and annuity money stored away, they thought they got all this broke, but they couldn't sue it in the state of Florida. I don't think those laws are applicable in every state in the same way. But go ahead, Camille.
Okay, let me speak to that. Okay, so the life insurance is not, you can't touch the life insurance, but once those benefits are transferred to the beneficiary, then the rules are different, because now those benefits becomes the beneficiary becomes the owner of those benefits. So let's say, and when I talk to my clients, I talk to them in terms of, let's say you have an adult child, right? And they're the named beneficiary on the insurance policy. They get $1 million insurance policy. They're married. After the funds are commingled, the spouse will look at them and say, I'd rather have $500,000 than be married to you, right? They file for divorce and they could potentially get the $500,000. They could potentially get half. However, if you have an irrevocable life insurance trust and the money is in the trust, the benefits are in the trust, if they get divorced thinking they're going to get half, they're going to be sadly disappointed, because they're going to realize that, your spouse don't own those assets. The trust actually own the assets. They have use, enjoyment, and control. Well, use and enjoyment, and sometimes in certain cases, if they're the trustee, control of those assets.
That's good stuff. That's good stuff.
All right, we're going to move right along and see if anybody else on the stage have a question that just joined the stage. Donald, Gary.
Yes, I have a question about the trust with Camilla. What's the price on an average trust, making a trust?
There's no price on, and I know people ask this question all the time, but it just depends. It depends on the market. It depends on the attorney. It just there are a lot of factors that it depends on creating your trust. So.
Okay, so you don't have do you do trust, or you
I do
to someone else?
No, I do trust. I do estate planning, probate, father's rights, and I'm transitioning into business succession planning.
So I'm hearing you say that there needs to be a consultation, Kimlia.
Yeah, I mean, I don't give my clients a fee until I evaluate their assets and understand their goals and their objectives. If I give them a fee and then they come and I find out that they need a Q-tip, I find out that they need a special needs trust, they want an irrevocable trust or revocable trust, then they try to hold me to that. So I don't get myself into those types of situations.
Very good, very good. Donald, does that answer your question?
It does. Do you do estate planning in South Carolina?
No, I'm actually from South Carolina, but I don't do estate planning there. I'm licensed in Maryland and DC.
Let's go, South Carolina.
Absolutely.
Do you see my picture up there? I'm trying to put together this. I'm putting together this development right here, and I wanted to know if I could put that in a trust, and then work from the trust.
Sure.
And I do understand trust, and I'm looking to get one formed to put assets in that trust and
Let me kind of explain it in the most simple terms. A trust is a legal entity that allows you to transfer ownership to this legal entity. It just, you're transferring ownership, but you still have use, control, and enjoyment of those assets.
I got that. Mm-hmm. And I like to operate through the trust versus the straw. So I'm trying to figure out how to do these things, not through the straw, but through the trust, having the trust own my assets. And then, like you said, I don't own them, the trust owner. But I don't want to work through the straw man. I want to be able to pretty much operate. Only time I want to use trust, the straw man is when I'm doing business directly with the United States, if that makes any type of sense.
So, Donna, you're going to have to consult with an attorney license in South Carolina.
Good. All right. Thank you.
Mm-hmm. You're welcome.
Awesome. Gary, did you have a question? All right. Well, thank you, ladies and gentlemen, for coming in. I'm just going to.
I have one more question.
Okay. Yeah, I was going to open it up to everybody. Just whoever has final and closing remarks, go ahead and make your remarks at this time.
Okay. One question, and I'll give my remarks. My remarks actually are: thank you, Shateka. You're doing an exceptional job in this room. You're so sharp, and everyone, if you're in this room, you need to talk to a professional. Call DM Shateka and all these wonderful people like Flip and Euro them. DM them right away. I wanted to ask Camila this here. Camila, with doing business succession planning and trust planning, you agree that one of the number one ways to fund these particular plans, succession planning and estate planning and trust planning, is with life insurance, yes?
No, I don't make that assertion. I think it just depends on the individual. I won't necessarily say that, because there are people that don't need life insurance. I mean, if you have millions and millions of dollars and you don't feel like, and I have clients that say, I don't want life insurance, but they are single, they have millions of dollars, and they don't feel like they need to make that investment.
Girl, it got this little trust journey. Go ahead. I got you. I'm wrapping it up right now.
Their objectives are.
Is that your normal client, your the majority of your clients, or do you find some that do fall in that segment that they do need life insurance to fund their trust?
I know there are some that the majority of my clients don't use life insurance to fund their trust. But to your question was, do I feel that life insurance is the number one thing used to fund a trust? And in my experience, the answer is no.
That's interesting. Thank you.
Mm-hmm. It just depends on the person. It depends on their goals, their objectives, and their what their values are. And like I said, I have clients that feel like I have millions of dollars. I don't have any kids. I have nieces and nephews that I want to leave my assets to. So I don't see a reason to invest in insurance.
And the reason I asked that question too is because typically, if people have an estate that there's still extreme debt owed on the estate, in their assets within that state, and they wanted to transfer, normally that's when it's the case, particularly that they get the life insurance, because it's easier to fund that to make sure the state transfer to the family tax-free with that. And in which some of those cases, there's another thing called STOLI, stranger-owned life insurance, that people, when they no longer feel they need the life insurance, are purchased by people like Buffett them. So that's the reason why I was asking all that.
No, it's interesting that you said that with regards to having mortgages. I just had a conversation in my group tonight about what happens when your loved one passes and there's still a mortgage. But I do have clients that have life insurance policies on their mortgage. So when they die, they do have, it pays off their life, it pays off their mortgage.
Oh, Camilla. Oh, I would like to know more about that, because my aunt told me something about that, and she didn't say the specific name, but you just described that specific policy. Could you elaborate on that?
It just depends on the individual. I mean, it's just an insurance policy that if you put insurance on your mortgage, and if you die, it pays your mortgage off. I've had people that have life insurance on their automobiles. When they die, their automobile is paid off. I mean, I don't know if it's worth that investment, but people have different strategies for why, and different reasons for why they do certain things.
That's just a term policy. It's just a term policy for the length of your mortgage term, right? So if I have
yes, 30, only for the mortgage.
Mm-hmm. Got you. Thank you, Flip. Because my aunt, she said it's a certain type of policy, but she never put a name on it. And right now, my grandmother owns a home in New York City that's worth $800,000. She's 80 years old. I'm the only one who's financially literate in my family, and I'm the one she's counting on to get those things in place. So that's one of the main things I'm looking into, to be able to protect the house. She said she had to have it on her home insurance or something like that. It has to already be in there or something like that.
No, I didn't say that at all. No, I said it's just a life insurance policy on the mortgage.
Oh, no, I'm thinking my aunt. My aunt was telling me that it has to be something that was already on the home insurance. If it isn't there, could I add that on at this point or no?
You need to do, but
whoever's on
Flip, we can't hear you, Flip. You might have a bad signal.
And Euro, at this point, as Mama's 80, you can't add coverage to cover that at this time. To miss that window.
Okay, thank you, Mr. Jones.
Flip, Euro, can you hear me on the mortgage protection?
Yes, I can hear you now. You was breaking up a little bit, but I hear you clear now.
So what it is it's simply just a term policy on the loan amount. Protect the entire value of the home. If it's an $800,000 home, but grandma already owns the home, there's no need to have mortgage protection. Whatever the equity, whatever the difference in the true value of the home and whatever is on the note, you want to just cover the note. Does that make sense? That's what mortgage protection is about, covering the note, the rest of the loan, if something happens to the borrower.
Gotcha, understood. Thank all of you guys. Thank you, Leah. Thank you, Mr. Jones. Thank you, Flip. Thank you, everybody, for that, because that's a real question that I really have pertaining to my family, and I'm trying to, solve that. But you guys definitely brought it up and gave me much more clarification. So I want to say thank you so much for that information.
Thank you for the question and keeping the conversation going. I really appreciate all of the insurance brokers that are in the room. Thank you for joining this conversation. It's a really good conversation tonight. Hope you guys can come back next Thursday night at 8:30 p.m. Eastern Standard Time so we can continue some more conversation, because you always bring great value, and I always learn every night that I'm on one of these rooms. So with that being said, I'm going to allow you guys to finish it up with any closing remarks.
I just want to say thank you, and I want to say special thanks to Camille for the value that she brought. We need more healthy relationships with our estate planning attorneys and serving our clients best. And again, thank you for inviting me to the stage, Shateka. I appreciate you and everyone in the room.
Absolutely. You always bring value. Thank you.
I have a last statement. Miss Camille, my grandmother explained to me, or she expressed interest in actually putting the house in a trust. Would you be able to assist with that?
You said you're in New York?
Yes, the home is in New York City, and she's interested in putting the house in the trust to protect it, so we can kind of keep it in our family name.
I wouldn't be able to do that for you, but I would be. I just send me a DM, and I'll be able to see if I can find somebody for you.
Okay, thank you so much.
Oh, you're welcome.
Thank you so much, Kimlia. Ton, do you have anything, or Flip?
I was just going to say thank you. I appreciate you. You always come to our room on Tuesdays, and I appreciate the value you add. So I really, really thank you for allowing us to share the stage with you tonight. This was a beautiful room, and I learned something. Yeah, back door for Flip. Just glad we can just continue that conversation. Life insurance, so huge investments, estate planning, all those things as far as generational wealth. I'm glad we can be here tonight and, just learn. It's always learning opportunity here.
Absolutely, gentlemen. I appreciate you. Some of our other agents had to leave, but if you're just tuning in, we were talking about all the many benefits of, having a life insurance policy, and so many people don't know what they don't understand that there's so much more to this than just death benefits. And I kind of mentioned the 6 reasons people look at, 6 steps to financial independence. And I'm gonna just go over it really quickly as I close the room. There's 6 steps to financial independence. So if you want to take notes, the number 1 step is cash flow. You want to be able to earn additional income and manage your expenses, right? You can do that with insurance, big time. The number 2 way is emergency fund, right? You can save 3 to 6 months of income or even more. You can prepare for unexpected expenses. You do this through insurance. Instead of going, to your credit card or a loan, you can actually become the bank and use your insurance, right? The number 3 way is debt management. How do you consolidate your debt or eliminate your debt? We just talked about at the very beginning, if you weren't here, the very beginning, we talked about how to eliminate debt through an actual specific policy where it can give you your exact financial freedom date. All we need is your, the number of debts that you have, right? Okay. And the interest rate on each one of those debts. And we can tell you exactly when you're going to be financially free, right? The number 4 way is going to be proper protection. How do you protect against loss of income or protect your family assets? You can do that through insurance. The number 5 way is to build wealth. How do you outpace inflation and reduce taxes? Professional money management, those types of things. That's insurance. The sixth way is to preserve your wealth, to reduce taxation. Many people know about the 401ks and all those different fours that we talked about, the 403s, 457s, and they know about, you know, IRAs and all that, but they don't know that the way to reduce taxes, and the wealthy and the rich know this, is through insurance. And that's how they build their legacy, and they build their companies through insurance. That's how they preserve their wealth, and they send it from generation to generation. That's how they become the lender and not the borrower. It's through insurance. So these are the 6 steps to financial independence, and you can do all of them with insurance. Now, not to knock, you know, stocks or real estate and all that, because I dabble in all of it, okay? But there's none of them that can fit all 6 of these, okay? But insurance. So I want you, if you don't have an insurance policy, to consult someone that you know that's a licensed professional that can speak to this and can help you get out of debt, help you have an emergency fund, help you with a cash flow, help you with your proper protection. You're building your wealth, you're preserving your wealth. Get with somebody so that you can position yourself to be financially free and to leave a legacy for the next generation and the next generation. Because a good man or woman leaves they leave a legacy. Okay, so that's what we want you to do with that insurance policy. Now, if you get term, we already said this, I'm going to say this again, if you have to have term because you can't afford anything else, that's going to be beneficial and give you a return on investment, because a term is really a donation, then make sure that it has a return on premium so you can get some of that money back. Okay, because the only way you use a term policy is if you die. You know, that's really it. Okay, it is a, I don't want to say morbid, but it is really just a donation. And so you want to have, make sure that it's convertible. It can be converted to a better policy, one that you can afford in the future, or make sure that you can get some of those premiums back if you have to use a term policy. All right. So, you know, getting a term policy and investing the rest, everybody cannot invest. Everybody don't know how to invest. They're not skilled to invest, but the insurance companies know how to do this very, very well. And that's why so many banks use insurance. Okay. The big banks, the Banks of America, the Wells Fargo's, all of them, Chase, man, they have insurance. Okay. So you want to be like the bank, you got to operate like a bank. All right. So that's all I have. If nobody else have any other closing comments, I'm going to close the room on the count of 3. 1.
Shateka,
go ahead.
Is there any way you I don't know if you offer this service or not, but like, I love the way you broke that down, right? And I'm willing to pay you you know, some money, to, like a one-on-one. Not, it doesn't have to be anything extensive, but just to break that down in little details for me.
Oh, sure.
I would love that for myself, you know, my own knowledge, like to just understand those 6 steps, because I love that. I love the way you broke those things down, and I want to be able to fully comprehend that. So I would love to get like a one-on-one with you where you just teach me just the concept of those and those details. I would love that. I don't know if you offer that, but
yes, I do, and it's actually complimentary. I don't charge. So just go to the link in my bio and just, you know, click the link, and you can schedule a consultation, and I'll be happy to help you, because this is all about empowering one another. Somebody did it for me, and I'm gonna pay it forward just like they did for me. All right, so there is no fee. Next week we'll talk about the 4 financial cornerstones. So we definitely want you to come back at 8:30 p.m. Eastern Standard Time. There's no other questions. I'm going to close the room on the count of 3. 1, 2, 3. Have a great night. I have to end the room, or y'all still talking? I also end the room. Okay.
Hey, Euro.
He's gone. Yeah, he liked the way I broke down them 6 steps to financial independence. He wants you to break it down even further.